Hi class, welcome back. I'm Matt Fisher, your accounting professor. So let's continue with capital budgeting. Now we're going to move into the first time value of money model. So let's take a look at this example now. Let's assume that we have some equipment that we might purchase, and the cost of this equipment is $200,000. So I'm writing $200,000 negative because that's the cost of the equipment. Let's also now assume that the cash flows associated with this will be $50,000 each year for 5 years. All right, so I like to visually put this into a timeline so that I can see what's taking place here. So now I can see it's costing me $200,000, and then these are going to be my cash flows. Now, note that I said cash flows. In the previous method, the accounting rate of return, we used accounting profits. That's the only method that we're going to use accounting profits. All these other ones, we're going to be using cash flows. So these are the cash flows that we anticipate associated with this investment. So now what we want to do is calculate the net present value. So that means the present value. Present value is year zero. That means that's today. That's our starting point. So this is already present value, $200,000, all right? Now, the $50,000, however, is not in present dollars. And let me point out, when you have the same dollar amount, equal time periods apart, each are a year apart, so the same dollar amount, equal time periods apart, that's called an annuity. And we can calculate that, we can bring that back to the present value in just one step instead of doing each one separately. So what I'm going to do is I'm going to find out what all of what the stream of cash flows is worth in year zero. Okay, so I'm going to say my formula is 50,000 times some factor. And when I take that 50,000 times some factor, that's going to give me what it's worth today in year zero. So how do I find this factor? Well, Excel can calculate it for you. Calculators obviously can calculate it for you. So you can go to your instructions in your textbook or in your calculator and see how that's done. Or you can go to Excel once again and also see how that's done. But most textbooks also have the old way that we used to do this a lot, and it's through the tables. There's a table for present value of a single dollar, and there's also a table for present value of an annuity. Be careful, because there are also future value tables. We are not calculating future values. Future values will be this direction. We're calculating the present value. So make sure that you're using the right tables, because almost always the textbook will give you 4 tables. You always want the present value tables, the PV tables, and you want, in this case, the present value of an annuity. Now, there's 2 things we need to know to pull this number, this factor out. We need to know the number, the years, the number of periods for this cash flow. And this cash flow is for 5 periods in my example. And then we need to know what the interest rate is. And we're going to assume that the interest rate is 6%. All right. So now if we go to the present value of an annuity table and we go across from year 5, from period 5, I should say, and then down from interest rate 6%, you will see a factor of 4.2124. Now this is rounded, obviously. If you use your calculator, it's not going to be rounding this, or if you use Excel, it's not going to round it. But in textbooks, this is rounded. And I looked at several textbooks, and some of them rounded at 4 places, some of them rounded at just 3 places. I'm just letting you know that the one that I'm using has rounded it to 4 places past the decimal point. So now I can take my 50,000 times this factor from the present value table, and it will give me $210,620. So that's what this stream of cash flows would be worth today, $210,620. So now I'm going to put underneath here a line, and this is the present value of this cash flow. The present value of this cash flow is already $200,000. That's already at year zero. So now what I'm going to do is I'm going to add these up. Hence the name net present value, because these are present values and now I'm going to net them. 210,620 minus 200,000 gets me 10,620. All right, so that's our net present value, 10,620. Sometimes a lot of students at this point, they say to me, well, that's not a whole lot of money to get back. Well, you got to remember that we're not just getting this, we're discounting this at 6%. So this investment is earning 6% plus more. So it's earning more than 6%. If this net present value had been exactly zero, then this investment would still be a possibility because we discounted it at 6%. So if this is zero, then that's telling us we actually earned exactly 6% on this investment. All right, that's going to be a little bit important in the next video. Right? Now, let me just change this example slightly. Let's say that we have another cash flow. We think at the end of the life of this asset, it's actually going to have a salvage value of $10,000. All right, so that $10,000 then also needs to be discounted back to the present. Right. So is this $10,000 an annuity? Is it taking place every single year? Hopefully you see, no, it's not. It's only taking place one time. So we're going to want to use the present value table, but the present value of $1. We don't want to use the present value of an annuity because it is not an annuity. So if we go to the present value of $1 table and go down, let me write in here, it's going to be 5 periods because it's 5 years out, and the interest rate we're using is 6%, okay? Since it's 5 periods out and 6%, we'll go to present value of a dollar amount, go across 5 periods, go down at 6%, and you'll get a factor of 0.7473. So now what we do is we multiply our 10,000 by 0.7473, and we'll get $7,473. And so now we would subtract 200,000, add in 210,620, add in 7,473, and we will get $18,093. So now our net present value is increased anymore, which makes sense because we had an additional cash flow out here. We felt like our investment's going to be worth $10,000 that we'd be able to sell and get that cash. All right, class? So the net present value method is a really good method because it's taking in all this information about cash flows that we need, and then it's bringing it all back to the present. It's saying what its worth is today to us. All right, so it's important to note that it does use time value of money concepts, obviously, because we discounted these back to the present. And also, it is a little bit harder than the other methods, but it really is one of the most popular methods. In the next video, we're going to go over internal rate of return. So stick around for that method, and we'll see you soon.